Let's get to our first guest this hour. Francis Tan is back with us, Chief Strategist for Asia at Indosuez Wealth Management, joining us live around the desk here at the SGX. Francis, good morning. Great to see you again. Always a pleasure having you on the show. So lots happened since the last time you were on, and we talked. On the latest tariff news, what do you make of it?
Oh, I guess the latest tariff, mainly if you look across the tariff announced for many of their countries, generally the tariff rates are lower than what we have seen since Liberation Day. So I guess this is part of the Trump's out of the deal, whereby he came up with a very high tariff rate and wanting countries to come to him and to start negotiating with him. So I guess it's, perhaps we call it the step number 3 in the tariff negotiation. And at the end of the day, what he really wants is to tell the American citizens that this is a win-win for everybody. Now, a lot of countries are coming to us, telling us that they are willing to accept our terms, investing back in our country. But if you look at the latest GDP numbers from the US, I mean, the second quarter numbers, sounds like a good 3% quarter-on-quarter seasonally adjusted growth. But if you look carefully and if you drill down into the numbers, the consumption part or the investment part, investment grew very slowly at only 0.1 percentage point of the 3%. So is Trump getting the kind of investments coming in? I don't know. But as you can say, of course, it's in the pipeline going forward. Right?
Yeah, and of course, most important politically for any president is what happens with jobs, right? And, we had that, the payrolls numbered out last Friday. A bit of a shocker. Huge miss on the headline, then the revisions, huge revisions in the prior 2 months. Trump says, look, the numbers were rigged. The head of the BLS gets sacked, gets fired, etc. And now we're trying to decide, look, how real are these numbers? Can we trust them?
Yeah, so Martin, let me tell you something that's even more shocker. Other than the downward revision in the numbers for the previous months, if you really look at the entire non-farm payrolls and you take away the governmental related jobs, the education related jobs, and the healthcare related jobs, the rest I would call it more private sector type of jobs, that only grew 4,000 jobs in the latest month. And guess what? Since the start of 2023, the average for this grouping of industries was gaining around 44,000. So 4,000 dropped in the latest month versus 44,000 on average. At the end of the day, the entire US labor market is slowing down, that's for sure. And of course, now with immigration slowing down, and I think it's going to impact the total non-farm payrolls a lot more. I mean, since COVID, where during COVID in 2020, the Americans lost 20.5 million jobs. Then in the first year in 2021, it gained 7.2 million. Guess what? Last year, it was only a 2 million jobs gain, and we think that it's going to gain 1 million this year.
So, Francis, let's put it all together. It seems like you're suggesting that, yes, pretty much confirmed now, the U.S. job market is at stall speed, is stalling, right? We had services ISM out overnight as well, showing the services sector, 3/4 of the U.S. economy is also at stall speed. Would it be too much of a stretch to say that we're just on the abyss of a recession?
Well, it's of course the prediction to a recession always takes some time. It's really hard, but it's like boring a frog in the water. Is the frog going to die at 60 degrees Celsius or 70 degrees Celsius? It really depends. But right now we are continuing to see that the temperature in the water is moving higher for sure. I mean, if you look at the job openings to the unemployed ratio, it's 1.06, and it came from a high as well. So there are lesser jobs available. The quit rates are going down as well because Americans perhaps are more cautious about the future. They're hanging on to their jobs tightly right now, and the employers are also coming up with less job listings. I mean, if you go at Indeed.com, for instance, job postings are also on the way down. So all these are a good sense of the labor market.
And I got to ask them, I mean, job openings, JOLTS, right? You have to wonder how accurate those numbers are as well, because we had Jeremy Siegel on from UPenn, from Wharton, just yesterday, saying that, look, the response rate or the participation rate, right, for the JOLTS numbers is only about 20%. Chery?
Yeah, so where to lean on, Francis, was going to be my question here. So macro environment, less reliable. Perhaps you can count on AI to deliver?
Well, certainly. I mean, if you look at how industries have evolved over the past few decades, it was robotics, automation that changed the life or jobs in the manufacturing, in the goods producing sector. Right now, AI is coming in a big way for the services related sector. And as Martin just mentioned, the US is a big services economy. Back in Singapore over here, we are a huge services economy, I think around 70% of our GDP. So AI will potentially be also the big disruptor for jobs, including my job, I believe, in the future. However, it really depends on whether AI is treated as a labor-augmenting technology or a labor-replacing technology. So at the end of the day, for workers or for the labor force, upskilling, reskilling is so important that to ensure that this AI is only going to be labor-augmenting and not labor-replacing.
Let's just make sure that AI doesn't take over our jobs for sure. So getting to yet another point regarding your calls here, very interesting because you're actually upgrading U.S. equities now from underweight to neutral, and you're actually sort of standing by to go to overweight when it comes to U.S. equities. So you like equities all around, and that is that sort of versus your less favorable calls and views on bonds?
Oh, yes. Well, certainly we have been quite cautious on U.S. equities, especially after Liberation Day this year. However, after looking at the latest earnings numbers as well, we find that the overall economy is still pretty robust in a way. I mean, of course, Martin was talking about, when's the recession timeline? But between now and the recession, we don't know the timeline. So it's important not to miss out in the market as well. So we are putting it to neutral right now. Doesn't mean a high overweight, but neutral across all our risk profiles.
But when it comes to EM, is there a single best idea, your favorite market in the coverage?
Certainly. When it comes to EM, I'm still thinking Hong Kong stocks, where you are right now, Chinese stocks. I think those are some of the key ideas that we have right now. Despite the pretty strong year-to-date up wave in Chinese or Hong Kong listed stocks as well, we still think that the valuation is still pretty much attractive for investors who have been shunning Hong Kong or Chinese stocks over the last couple of years. It's time to inch into it a little bit more.
When you talk to your clients about China markets, what is the number one question you're getting? Are they still hesitant, perhaps asking a lot of questions? Well, but then, China market, equities markets that tends to do this. What do you say to them?
Well, there isn't really a number one question. There's a number 1, 2, 3, 4, 5 questions. They're always very concerned about when the real estate is coming up as well, because real estate at the end of the day drives the consumer sentiments, and with consumer sentiments not up, it's hard to have consumption higher in the next period. Second question is what's the policy support, both on the monetary and the physical angle, that the Chinese government will be coming up to defend the entire area against higher tariff. I mean, although they are going through negotiations now, so lots of questions coming from them, but these are the two top ones.
Francis, when you take a look at, let's say, the benchmark, which is Wall Street, right? We're at or near record highs, right? And the market seems to have priced in what you were just talking about, that with tariffs, right? You start high, then you end up slightly not so high, right? Meaning it could have been worse, right? Yeah. This is with the reciprocal tariffs, the base layer. Yep. Now that the president is threatening to act on the sectoral tariffs, the 232 tariffs, right, on chips, for example, which he says the numbers are imminent. Are we likely to see a repeat of the same thing? Is it going to start high with just an outrageous number and then end up slightly not so high?
Martin, you're talking about taco again, right?
Yeah.
Well, it's tough. I mean, if you recall, other than chips, pharmaceuticals, maybe as high as 150%. I believe chips high, pharmaceuticals high is going to cause a very big dampening effect on the entire U.S. economic growth. And
has it been priced by the market yet?
No, I don't think it's been priced by the market yet right now. Yeah, because it's still in the flux right now. Yeah. But I don't think eventually it will be priced so high in terms of the tariff. It will have to come down eventually.
Yeah. What do you make of, you watch the bond market very closely as well, I know, right? And post everything that happened in the last couple of days with the huge jobs report missed, the firing of the head of the BLS, Adriana Kugler resigning early, etc. Right. We had the curve make some pretty unusual moves, right? And for different reasons too, the short end as well as the long end. But net basically we have the curve steepening very noticeably. What is that telling you? What are you doing with that?
Well, the curve steepening is on the back of two factors. Number one, the higher probability of a September rate cut.
Right, that's the short end.
That's for the short end. The longer end, the curve moving higher, I guess it's really now markets thinking where the future can be going forward. Perhaps the rate cuts is going to drive a little bit more economic strength. That's perhaps seeing this steepening coming up.
Yeah, and meaning the short end is still good value?
I believe the short end is still of a good value right now, because I think, as we are mentioning right now, the labor market is signaling that the US economy is continuing to disinflate. And should the tariff be maintained at a high rate, of course it's going to cause some stagflationary concerns, but the overall economic growth is still going to slow down further. I mean, just now I was mentioning non-farm payrolls for the whole of this year, 2025, could only gain 1.02 jobs, million jobs. So I think that is going to see the US economy continuing on the disinflationary path, and that's where I believe Trump may get what he wants. Short-end rates much lower than currently. Yeah.
Okay, watch the Fed. Excellent. As always, thank you. Francis, great to talk. Keep safe. Come back, see us again very soon.
Thank you very much.
Pleasure, always ours. Francis Tom there from Indosuez Wealth Management joining us live here at the SGX. We'll take a quick break. We are